Coming up, recession. Actually, let's try that again. Coming up, recession warning lights flash as the Fed preps for cuts and the US-China trade war escalates. Bitcoin rockets towards 100K with stocks like HIMS, MSTR, and Microsoft following in its wake. All this and more on today's After Hours. You're tuned into After Hours for May 2nd, 2025, where headlines meet price action and every story has a ticker. I'm one of your hosts, Tom Hartman, alongside Mike, the prop firm Prince Christensen, to extract the signal from the noise. After Hours is brought to you by TradersPost, the greatest automated, I'm sorry, Mike, I gotta do this the right way, the greatest automated trading platform known to man. But more on that later. For now, before we turn our sights to all things markets, Mike, how was your week? I can't hear Mike, Peter.
We've got sound effects on the show now. This is incredible. I had no idea that was coming. Thanks. Also, let's not get ahead of yourselves. I wouldn't call myself the prop firm Prince just yet.
Well, I had you as prop firm King, but I was like, okay, the Prince he's soon going to be graduated into King, and wait till you get to Emperor. Wait till you get to Dictator and Tyrant. So that'll be pretty interesting.
I love it.
I gotta say, it's funny here. I have new glasses, and I forgot I don't have the new prescription in where I can see far. I can only see midway. So I'm like, all prepared to read it, and I'm like, I can't read on the other side of the room over here. I was like, everything is blurry. That's pretty interesting. All right. Well, this week it's been pretty interesting for me because we've been talking about, and we got to do like a compilation of this on for After Hours. We had talked about where the low might be in for Bitcoin, and then we should see a big rally from there. And frankly, I think t-shirts should be made with how we've called this because, I mean, Bitcoin's almost up to 100,000. This is one hell of a move, and I find it to be fascinating. But before we get to all of that, I do want to start with some of the. Actually, I just want to mention this. For the traders and automated traders in the bunch, that's who's going to be watching this content. I want you to guys just to reiterate here that the macro and micro news that comes out, like you need people like Mike and I in order to go through some of the stuff, in order to pay attention to all the different things that are going out there. Like you should be listening to the podcast, you should be on Twitter, you should be just to get the ideas of what's out there. And I find it so refreshing to be able to have this time with you, Mike, here every Friday to go over some of the things that are going on. Because even I, like, when I do the rundown for the show, I go, wait, what happened?
Yeah.
What actually moved? And then you'll message me and you're like, oh, Tom, did you see this, that, and the other? I didn't even know that was going on. So I think it's really worthwhile for everyone to be paying attention to this. So that's great.
I totally agree. I think it's really easy to get lost in the charts every week and sort of miss the excitement around what's moving those prices in the first place. So the nice thing is kind of unfolding what's moving markets, but also what might be moving markets in the future.
That's right. Well, for this week's stories, like I'm pretty excited about the two tones because we have this whole thing where there's these recession fears. Now even my recession signals are flashing. And then you also have stocks moving in these crazy ways. So let's start with the bad news first. When we're dealing with the bad news here, I'm seeing, first of all, the US Q1 GDP numbers came out, and it was negative 0.3.
Right, down 30 basis points from a projected up 30 basis points. So we were technically 60 basis points below expectations.
That's right. And if I actually wouldn't mind checking the Fed tool, I think they're saying that the market is pricing in 60% chance for a 25 basis points cut in June. I don't know if you're seeing that.
Yeah, we'll have May 7th, which is next week, 96% chance of a continued pause. And then by June 18th, about a 65% chance of finally, well, actually at this point, the market's pricing in a continued pause actually in June. We don't see a cut until potentially July with a 55% chance at this point.
That's right. The 10-year Treasury did dip to 3.8% some weeks ago, but it's back up to 4 point whatever now, the 10-year, which is like not good, right? This really lends into that thing that Ken Carson, which we'll talk about later on, was saying that yields are not going down like below 3. The 10-year is not going down below 3. And there's a lot of people who are betting on yields going back to 0. In fact, I was betting on yields going back to 0. Have you ever heard of Alex Gurovich? I might have talked to you about him some time ago. He was like really big on this trade. He's the one who set me up on this trade some years ago, actually before COVID hit, where you can bet on Eurodollar. It was him and John Burbank. You can bet on Eurodollar futures and then make a bet that the interest rates were going to go down to 0 super quickly, and that you can make oodles of money that way. And I did, and it was like this really amazing move. And he had been right about a bunch of different things. I placed money on that, and it was one of those things where you make life-changing money in one trade. But he had then called for interest rates to fall back towards 0 over the last, let's say, like in 2022, 2023, and so on. And it's been interesting to me how that not only did that not happen, we're not even getting close to 0% interest rates. Like, we're not even anywhere there. Trump can't even force Jerome Powell to get down to 0 interest rates. We're not in that vein. So if our new low is at 4.3, 4.2, well, the next inflation bout that's going to happen with this trade thing, the supply chains, we're already seeing supply chains being disrupted because of it. Well, we're going to have the same inflation shock that we had, like similar supply chain disruption, cost push inflation. That's going to happen again. So
while interest rates are already elevated.
So how do we not get to 8, 10%? Like, I just don't see how we avoid that. And so the trade there of short bonds, I mean, that's a pretty home run trade, right?
Sure.
The markets are not pricing in 8% rates in 2027 or whatever, 2028. That's not what we're seeing. So it should be could be pretty interesting. So I just wanted to bring up here because it's all good, well and good to talk about the macro trades, but I'm really fascinated about the poly market bets. If you want to pull up the screen, I was expecting to go to poly market and see a bunch of the bets. I always go to poly market for my Fed bets because the Eurodollar market, they changed that. It's no longer Eurodollar futures. You have SOFR futures, which don't behave exactly in the same way. You can't get the same amount of leverage on the options. It's the whole thing. So I love going to the poly market now and seeing what the probabilities are for the different rate cuts and hikes and pauses over the next year. And I was actually very surprised to see that if we're going to take a look at the Fed rate cuts in 2025, at most there's a 19% chance that's being priced in for three rate cuts in 2025.
Oh, so this is the number of rate cuts, not the amount that the rates would be cut.
Yes. Well, they're saying 375 basis points. I'm sure if they did 3 rate cuts, but it ended up being 150 basis points, that they would count that as 6.
Got it.
Yeah. I find it fascinating that these chances are not, it's pretty good chance we're getting some cuts this year if a recession is actually going to start. And GDP is already printed negative, and consumer confidence is low. There's a bunch of actually markers that, hey, yeah, why wouldn't we have a need for lower interest rates?
I guess the other side of that recessionary concern, of course, is on the employment side. We did get some positive news today with non-farm payrolls up to 177,000 with a forecasted 130K, and unemployment remained the same at 4.2%. So while GDP is pulling back, we still have stable employment. And it starts to, if we start to see more of an inflationary environment, we start to get closer to stagflation, right?
Yes, I mean, I wish I had the numbers for the birth death rates of companies, but what we're seeing is that because the last thing that's going to move is the unemployment rate, right?
That would have to move in order for us to feel like we're closer to stagflation, right?
Right. But but that would be like the last number to expect. And I've been taking a little bit of a dive into the methodology that they're using to calculate the unemployment rate, and it's like it's not even the same that what it was like 5 years ago. They're like playing around with these numbers, especially when you count the numbers that are in the public sector versus the private sector, and then the ones where the people have been laid off, but it doesn't count as unemployment until their severance is done. And so there's this weird delay, and then then everyone who's like in the gig economy, it's hard to calculate the hours that they're working. Like the whole thing about what's actually happened in the job market is weird. But what we actually want to pay attention to is the 401ks, right? We want to see if the contributions to the 401k starts to diminish. Well, that's less forced buying that's happening because of passive investing, and that's going to be a problem for the market. So the unemployment, I'm sort of like wishy-washy with it at the moment because I'm not sure what to think. But when I pay attention to, let's say, the what was it, the PMI, just pull it up here real quick.
Do you have a good resource on tracking 401k flows?
Twitter.
I've struggled to actually find a good public resource on that, so I'm curious what you found other than Twitter. But
well, the proxy is the inflows into the I think the Vanguard ETFs that cater to these sorts of things. But a lot of people pull that information from Bloomberg terminals, so that's why I get it on Twitter.
On Twitter.
But we have here, Peter, if you want to pull this up, I have the PMI showing, and I mean, this is sideways. Like I was expecting more of a leap up. We're getting some sideways action, some stagflationary actions here, which you don't see there in the, like I haven't been able to see this anywhere else in the cycle. This sideways thing, which concerns me. We're in the millennial generation. We're used to our dot-coms, global financial crisis, whatever, with intermittent all-time highs in between. That's the game. That's what we were taught over the last 40 years. Why is anything else changing from this? And here we're not getting that. It's this weird sideways middling thing. So when you take a look at what's going on the S&P, well, this looks, let me just hide some of this stuff. This is looking a lot like the recession we had in 2022. Like it's looking a lot like that, where we're going to get a bounce maybe to, up to 6,000, which is what Ken Carson is saying, and then roll over. It could be, what was this? Yeah, 2 years. It could be a couple of years before we're even starting to get out of the stagflationary thing. So I'm worried about that in the sense that I want the big booms and busts because I know how to play that. You can make so much money on options playing that, or so much money leverage. The sideways stuff, I don't have a lot of experience on. Where are you on your recession meter right now? Are you okay? We're probably going to have a recession by the end of this year, next year, or you're like, I'm not really seeing anything that's telling me that yet.
Not yet. As always, I'm always looking for the stock market to kind of send that signal. And it's so bullish at the moment that I want to see how both the NASDAQ and the S&P 500 respond to the 200-day moving averages. After that, if we start to post a close below that and we start to see a bigger pullback overall from the market, I would be concerned that that's an early sign of a clear recessionary signal from there. But I guess we just have to pay attention to the inflationary numbers from here, unemployment, and of course the month-over-month GDP changes.
Right. Just a couple of things before we round out that segment here. Along with the GDP contraction, sentiment is low, and IMF, I think, just on the 28th of April, they issued another warning of heightened recession risks, and they're talking worldwide, like a global recession, because of the trade wars. And then, what was it? China lifted some of the restrictions, and then on tariffs, and then Trump rolled over in a bunch of different ones. It's and then he put some back on. We're in this period nobody knows what to do for it. You're listening to what people are doing for wasn't it John was just talking to us about this week, where he's he had a friend who they don't know what to do with the employees in the company. They lost a contract because they don't know what's going on with the trade war. So a bunch of businesses are okay, well, we're just going to sit and wait and see. Wait and see.
Yep.
This is not so good.
And that's honestly a product of uncertainty quite a bit, where people don't know where things are going to go. Sometimes they sit on their hands, and that can lead to unintended outcomes as well, and second order effects that we couldn't have anticipated.
Yeah. There's this thing where people who are not exposed to markets and who've not started any businesses, a bunch of them really think of businesses as like an entitlement. I'm supposed to have this job. I'm supposed to have this job. No. That person who runs that business is burning through capital and hoping to, like, expecting to earn a profit. If that ever stops, why should he or she have to burn through their reserves just to keep you around? They might do that for a little while because onboarding new people afterwards is difficult. But at a certain point, they go, look, I gotta close up shop. Like, it's not worth it anymore for me to make these widgets. Let me keep the money that I made over the last 10 years, and I'm so sorry, but you're gonna have to go find another job. People, just regular civilians who don't know anything about markets, they don't necessarily understand that angle. I want to play this one thing. It's sort of like a preview for this interview with Cross Border Capital, Michael Howe, who's like OG liquidity when it comes to tracking liquidity. He worked for I think Salmon Brothers back in the day, so he's been around. And I thought this clip was pretty interesting, or this promo.
Do you see the capital war between China and the US at the moment?
Trade wars are a distraction war. The real battle is the supremacy of capital. American capital wants to dominate, but then so does Chinese capital. And that war is being fought out in currency and financial markets. Trump may well win the trade war, who knows? But it looks as if they're not winning the capital war, given the problems that the bond market in America is signaling. Now, I think we're in a new era now. The Chinese are focused on devaluing the paper yuan against gold because that helps them to devalue their debts against real assets. Those refinancing tensions tend to lead to global financial crises that have been triggered by excessive debt relative to liquidity. That is worrying because it's saying that the system is beginning to break down in terms of its ability to roll debt, and therefore a lot nearer a financial crisis than many people think.
Do you see the capital war between...
Anyways, that's totally worth it. I'm definitely gonna get a watch from me. I love Michael Howe. He's very clear. If you have a head for liquidity, have a head for this wonky stuff, it's definitely worth a listen. All right, switching gears to what'll feel like the exact opposite of what we've just been talking about, recession fears, is this notion of rocketing assets in all kinds of different sectors. You have Bitcoin, Bitcoin off the lows here, headed towards 100,000. Oh my God, who could have seen it come in? We did. This is, I mean, what a move in Bitcoin. What is that off the lows? 31% off the lows.
31 off the lows. What I even find interesting about this too is we had, well, at least in the last cycle, Elliott wave cycle, I was predicting about 107,000 as the resistance level, and that's what ended up printing as we got to a 1.2 extension. So if this is the next move in line, I'm going to go ahead and start to make my forecast here for where I think we're going. Because we did indeed make another nice Elliott wave. We pushed off the 0618 on the retracement, and it's following technical structure exactly the way you would expect. So what I'm expecting from here, as we pull off of these lows from confirmation, 142 next, potentially.
142, yeah, absolutely.
Okay.
And that matches what we're seeing here with the liquidity. I just love that we've been talking about this. Hey, once this move up starts, we have this liquidity move up into the right that's not ending yet until mid-July. Mm-hmm. Like, that liquidity has to flood through the system, and it happened like literally exactly when we were talking about it. And this move makes sense. So we're getting Bitcoin up to 97,000. So in 25 days, it moved up 30%. That's up. That's incredible. But then you also have HIMS that moved up. What was it? Just pull it up here real quick. Right off those lows that we're talking about before, we had HIMS up. Let me just hide some of this. Him's up 63%. Could that possibly be off those lows? Yeah,
HIMS is moving
63% off the
so
lows.
fast. Yeah,
It's
it's
just
very volatile.
unreal. Let me just hide this a little bit. This is unreal, and I love that. This is why I love my indicators, Mike. Like my yearly average over here is exactly. I mean, it came exactly down over there, and moved up. And what a move! We got to hit up those Him House guys to see what their podcast is going to be like, because that's pretty incredible. And this is not you can't say this is a crypto play, right? This is not because of crypto. This is liquidity has been eased. You have Microsoft. Their earnings came out. They did great. Look at that gap up. I mean, unbelievable. 10% move on there. 27% off the lows. Absolutely incredible. Tesla.
I think I said correctly in a tweet of mine recently, the stock market trades like crypto now.
That's right. More than the altcoins. You don't even want to be in altcoins. You want to be in some of these things, especially have options.
Yeah, it's moving. No question about it.
Tesla up 18% week over week. Palantir up 20% week over week. Robinhood up 20% week over week. I mean, it's just a rally in all these different assets, and you can't say they're all the same trade. Well, they're all the same liquidity trade. And once that volatility came out, we got out of the window of weakness from in March. We got past the thing in April, and I think you even said April was the month you were looking for to see if there was going to be any significant drop. And if April passed, it was 2 shows ago you said this. If April passed and that wasn't the case, you would expect a rally from there. And that's exactly what we're seeing. Just amazing how these moves are happening. However, I don't know all the details for Palantir and HIMS and all that. I don't know the nitty-gritty of the microeconomics for that. What I do know is that if we take a look at the Bitcoin liquidation maps, what we're seeing here is I had shown this previously that there was $4 billion worth, or billions of dollars worth of shorts in the Bitcoin space, in the futures market for Bitcoin, and that stuff got liquidated, but hard. I mean, we're down to 1 billion here for Binance versus 175 million, which might seem like a lot, 10 times more, but it was 40 times more before. So a bunch of the move up that we saw are these liquidations that we were talking about. Again, over here, take a look at BTC on Binance, OKX, and Bybit. We're down to 3 billion, and before we were up higher versus 500 million. So here's the interesting part. Yes, there's still enough tinder inside for the shorts to get liquidated up even higher still. So getting up to 140,000 seems to me like a no-brainer, especially since we have this liquidity push upwards. But if it's not being met with a corresponding increase in the leverage for longs, then we're not getting to 250,000. And if that's the case, if we exhaust the short liquidations, and then there's no more bulls that come in, and that all coincides with the double top in the S&P over here, double top in the S&P. Let's say we get up to 6,000 on the S&P, and the double tops over there. Well, that all confirms a liquidity pull, like there's no more liquidity there, and a liquidity recession on top of the economy contracting. Well, that's not a 2-year period of recession like we had from 2022 to 2024. That's 5-6 years sideways market, even if the Fed cuts to 0. So the thing that bothered me here the most is when I take a look at the levels for Bitcoin. It would have been healthy if Bitcoin retreated down to the different VWAP levels in order to consolidate and build up momentum upwards. It didn't do any of that. All these moves up are just liquidations of shorts. It has not reconfirmed, which a lesson I learned from Mike a year ago. Confirmation. We didn't get any of that, which means this to me is one of the most unhealthy signs for the move up. This wasn't even like our move up that we had the last time Bitcoin did its run up, because it did actually reconfirm all these different levels, but it's not doing it this time. So this is air pocket. It gets up to, I think we can get up easily to 101,000 on Bitcoin once the shorts are liquidated. We get a little bit of move up with the option space and some of the leverage that gets us up to 144,000 because it's still liquidating the system. And then that's it. Bob's your uncle, mid-July, we're done, we're headed lower, and then I'm going to be shorting all the way down, because if we take a look at what Ken Carson was saying over here, one of his recent interviews on Real Vision, he was saying that the current rally should peak at about 5,700 to 6,000 before a major decline on the SPY, and then he's expecting 4,800 by October, and basically 3,900, 3,300 by February 2026.
So short-term rallies followed by a pretty sharp reversal to the downside.
That's right. And one of the signs that you're in a bear market is that the rallies are violent. 20% rallies in bounces in a bear market happen all the time. That's how people get wrecked all the way down. Sure. Even though they're right directionally, they can't position it properly. Whereas you don't get that on the move up. You get 2 to 5% days, 2 to 5% days, 2 to 5% days. So the bullishness that we're seeing in these assets right now, which is this relief rally because of like the window of weakness, still are going to face the headwinds of the tariffs, still are going to face the headwinds of the liquidity, and then we could be looking for a down move. So as traders, this is why it's important that like we take advantage of this. This is not a bad thing. It's a bad thing for everybody else who's not part of the markets and not exposed to markets.
Yeah.
It's terrible.
If you're not a trader, unfortunately.
It's terrible if you're retiring. Terrible if you need. I get all that. I'm not trying to be flippant about it. What I'm trying to say is that you go tell you plan for yourself and your family, and you go tell those that you can, hey, there's an opportunity to make money on the downside here. If you do that with puts, if you sell out now and sell out at the top and you hold, if you look for things to buy at the bottom, whatever it is, but holding through a stagflationary period, that's the worst thing you could possibly do. You're not making anything. You're getting eaten out by inflation. You're not making anything. Mm-hmm. And it will be traders like us who have the opportunities to top and bottom. So we'll see. All right. Anything else on that, Mike, before we move on?
I don't think so. I think I'm continuing to try to remain intraday and looking for some of those longer dated value buys over time still. So just like we've been discussing these last couple of after hour sessions, I'm going to basically just slowly dollar cost average over the next 6 months or so. So nothing too exciting yet.
Nice. Excellent. All right. So before we move off to market minutes, just a word from my sponsors.
Ask yourself this. Are you making trading harder than it needs to be? If you're trading manually or still coding just to connect to your broker, yeah, it's time to upgrade. TradersPost lets you automate trades using signals from tools like TradingView or TrendSpider or even your own custom setup. It works with brokers like TradeStation, Tradeovate, Coinbase, and a bunch more. I've been using it myself, and getting started was smooth. The platform's clean, setup's quick, and once it's running, it just works. And when you're ready to scale, more strategies, prop firms, or sharing signals with your community, TradersPost handles it. It's built to grow with you. Start your free trial at TradersPost.io. Trade smarter, automate your edge.
I think my first tattoo is going to be a TradersPost tattoo. I'm just not sure where it's going to be. Oh, we're back from break. Hey, everyone. All right. So just a couple of things to bring up that happened over the 1 second here. All right, so there's not a whole lot of things that I thought was interesting that happened over the last week for the market minute news. A couple of things that we did see is that Nvidia got a bounce of 2.5% as it unveiled what was it, 500 billion? Yeah. Some more investment within the space. CBEX options flow spiked as traders bet on volatility. So actually, if we take a look at the options market, I would have expected for the premiums to have come down some, but we're actually getting some pretty high premiums on some of these options even further out, which means that when you're getting the higher premium costs, when you're expecting them to be lower, that means there's still uncertainty and resistance like within the the equity space. That's not being reflected by the bounce that you're seeing on the assets. Gold is hovering around 3,300. Did you see that pullback in gold? And it didn't it's not skyrocketing, but it's not cratering. So it's sort of like, what's going to happen here?
A little bit of a consolidation zone so far. Yep.
I don't know what happens to gold and stagflation. I gotta start going through books from the 1970s to be what happens in stagflation. I'm a baby when it comes to this stuff. I don't know what goes on. Does gold rip? I don't think so.
It's hard. It's tough to try to trade against the trend on gold. I'll tell you that much. I would not resist the bullish trend on gold at the moment. It's still one of the best performing assets for the year.
So I get that on the physical gold and on the futures market. But let's say you wanted to be like, oh, I want to be cute and I want to go for the miners or junior miners. They're going to have headwinds with stagflation too. Like operationally, they're going to have headwinds with stagflation. So like I never know
potentially.
Like,
but even those miners, especially the names that I had listed off, what was it, 6 or 7 weeks ago on the show, the gold miners that are suddenly getting a ton of volume and trading activity, those are still moving upward.
I wonder what GDX is doing now. Let me see. Yeah, you talked about Orla. Let's see. What was there? Yeah, so Orla got a pullback of 13%, which makes total sense inside of a move like this. What was it? Newmont also pulled back. So like, I'm wondering if these are like buys.
That's
like, do you buy the dips on these gold?
You had brought in a couple of better analysts in that particular field, and I'd be curious their thoughts on it. I'm not as versed on the gold industry as I am in some of the other names that I tend to invest in, but still the trend is interesting.
Okay, so yeah, I'm gonna brush up on my stagflationary bets. Because in the 70s, the stagflation bet was don't bet on the stock market, bet on companies. Right? If companies with free cash flow and they're balancing the books properly and they were still showing growth with the stagflationary period, they left that period amazing. And so to me, it's like I see that within the AI space. I go, these years of stagflation is a time to shore up your skills, pay attention to companies who are invested inside AI development and integration within their products. That's the kind of thing that you might want to do in order to be on the good side afterwards. Maybe the buy and hold is not the thing to do in stagflation, but we'll see. Maybe there are sectors that just completely rip. Just like, no, I was about to make a dark joke. I'm not going to say that there. I'll just mention that there was a time where I bet on funeral stocks and those went really, really well. But hey, that's what happens. All right. The last thing I wanted to mention over here was SMCI jumped 12%. So like the AI plays are waking up. They're not doing, Bitcoin numbers. They're not doing Microsoft numbers or whatever, but they are waking up off the lows. So that should be pretty interesting still.
Yeah, I've been keeping an eye on a lot of the 13F filings from this last quarter as well. We're still another 13 days out before all the filings need to be complete. But Taiwan Semiconductor was one of those names that's been getting a lot of attention lately. Among a number of other obvious names, Microsoft, Pepsi, Comcast, Hershey, things like that. But interesting to see TSM make that list.
Pretty fun. I don't know, before we leave here, Mike, I got to say the new developments in the AI space, I thought we were like in the middle of the S curve. I'm an idiot. I don't know anything about this stuff. I thought we were going to be in the middle of the S curve for the AI. And more things have come out to blow my mind over the last month and a half than I think did the entire run up so far. My AI music, like I think I might stop my Spotify subscription and move to Suno because of what's going on over there. The development of MCPs, the model context protocols, the integration for different software. We have the context windows are all getting bigger. The reasoning models. Now we have reasoning models on top of reasoning models because you could tie things together in such a way that they super reason. I have. My wife is cheating on me with an AI, clearly. Like I know that's what she's doing, and she's not even hiding it anymore. She outright quotes the AI as if it's some other person about things I should do and things
she's
you
just
should
trying
do.
to train you on what you need to say.
So it's just been amazing. So like I just can't. It's so new that I can't tell how does that translate to Nvidia earnings. Like, I just don't know that funnel through if it's just like, that it doesn't go anywhere. It's like the long tail on Netflix. Remember, there was a few years there where Netflix like plummeted because like we saturated the number of people who were going to buy Netflix accounts. Everyone has 5 profiles. People are like, okay, Netflix will sell, and people are like, well, I use Netflix every day. And then they had to come up with a brilliant idea, get rid of the profiles, and boom, they jacked up the prices.
Yeah, and I think we've gone round and round on this one a few times, but I just think that the demand for compute power continues as more and more businesses adopt the technology, integrate it into their ecosystems. It becomes middleware between so many experiences, such that the model for even how the software is presented becomes more conversational over time. So I think more businesses start to use it, more startups continue to crop up around it. I don't think the compute demand goes anywhere. I think it goes up and up and up. So Nvidia obviously continues to be a clear winner in the space.
Excellent. Okay. Well, great time to be alive. So we'll leave it there for this week. Thank you everyone for watching. We absolutely enjoy going over the markets. If there's anything that you've seen that we haven't actually seen ourselves, please be sure to write those in the comments. And YouTube, if there's anything you want us to take a look at, we're happy to do so. Like and subscribe. It helps us, helps the algorithm, and helps us, show us the more eyeballs. And the more practice we get talking to other people, the more interesting and dynamic and fun we will get. Look, we have a soundboard now. We get to speak like we're the voice of God. We're trying to upgrade. We're trying to be here for you folks. And I think there's a pitch in a recent meeting, Mike, where Mike can pull the standing desk walking while you're on after hours. That'll be real fun. You got to see Mike when he's in full like get buff mode. It's fantastic.
Apparently, I looked very disheveled and a little sweaty at the time. I don't think any of our viewers are going to want to see that. So
they're gonna want to see it. Look, my wife is already saying, "Get Mike in his tight shirt and walk in." Let's get going. All right, perfect. So we'll be back next Friday for more after hours. And until then, happy trading.
Cheers, everyone.